Lesson 1. Understanding options trading, the basics. What is an option? In the world of stock market investing, an option is a financial derivative. This means its value is derived from an underlying asset, such as a stock, like Apple or Tesla, an ETF, or an index. At its core, an option is a contract between two parties. It gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price within a specific time frame. To understand this better, think of an option like a reservation or an insurance policy. When you buy an option, you are paying a small fee today to lock in a price for the future. 2. Key terminology you must know. To trade options successfully, you need to speak the language. Here are the 4 pillars of an options contract. Underlying asset, the specific stock or ETF the contract is based on. Strike price, the predetermined price at which the option holder can buy or sell the stock. Expiration date, the shelf life of the contract. After this date, the option becomes worthless if not used. Premium, this is the price you pay to buy the option. Think of it as the cost of the contract. Note, in the US stock market, one options contract typically represents 100 shares of the underlying stock. So if a premium is listed as $200, the total cost will be $200, cut $100 equals $200. 3. The 2 types of options. There are only 2 types of options, and they represent 2 different market outlooks. A. Call options, the bullish bet. A call option gives you the right to buy a stock at the strike price. When to use. You buy a call if you believe the stock price will go up significantly before the expiration date. Example. Stock XYZ is trading at $100. You buy a $105 call option. If the stock jumps to $120, you still have the right to buy it at $105, allowing you to profit from the difference. B. Put options, the bearish bet. A put option gives you the right to sell a stock at the strike price. When to use, you buy a put if you believe the stock price will go down. It is often used as insurance for your portfolio. Example. You own stock XYZ at $100 and fear a crash. You buy a $95 put option. If the stock crashes to $70, you can still sell your shares at $95, limiting your losses. 4. Why trade options instead of stocks? Options provide several advantages that regular stock trading doesn't. 1. Leverage. You can control 100 shares of an expensive stock, like Amazon or Nvidia, for a fraction of the actual cost of buying the shares outright. This allows for much higher percentage returns. 2. Hedging. As mentioned, puts act like insurance. If the market drops, your puts increase in value, offsetting the losses in your stock portfolio. 3. Income generation. Advanced traders can sell options to collect premiums, effectively getting paid to wait or paid to own stocks they already wanted. 4. Versatility. You can make money whether the market goes up, down, or even stays sideways. 5. The risks. A warning for beginners. While the rewards can be high, options are high-risk instruments. Unlike stocks, which you can hold forever, options have an expiration date. If the stock doesn't move in the direction you predicted by the deadline, the option can expire at $0, and you lose 100% of the premium paid. Time is your enemy when you are an options buyer. This concept is known as time decay, theta. Conclusion. Options trading is a powerful tool for building wealth and protecting your capital, but it requires discipline and education. In this first lesson, we've covered the what and the why. In the next lesson, we will dive deeper into how to read an options chain and how to place your very first trade. Your homework. Look up your favorite stock today and check its current price. Then, imagine whether you think it will be higher or lower in 30 days. Would you buy a call or a put?